People feel the pinch of inflation and cost increases when they go to the store, when they go shopping and the like.
Some of the capabilities the team has built over the last several years, to use the ports example, operating 24/7 in the ports, that's something we've been doing as a retailer for quite a while now.
The idea that economic activity will resume in full once you get to flu levels, it's very likely.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Yusuf Gameluddin in Dubai. Francine Lacqua will be joining shortly from the Bloomberg New Economy Forum in Singapore. Let's get you then a bit of a snapshot of what's coming up on today's show. Starting off with Europe, the continent is grappling with a worsening winter COVID outbreak. Germany pushes for more people to get vaccinated as Belgium reimposes work from home mandates. Amazon takes the Visa feud across the Atlantic after its UK card ban. The retail giant is now considering shifting its popular credit card to MasterCard in the US. And more top interviews from the New Economy Forum in Singapore. We're going to bring you more from our insightful conversations, from HSBC CEO Noel Quinn to the Microsoft founder Bill Gates. Well, in terms of the market action, we are in a situation where the market is looking for a footing and a little bit of direction here. This is the picture. The S&P 500 mini call just about 0.3% higher. The Asian trade, we had a little bit of a sell-off in tech stocks that weighed on sentiment, but that's just starting to shift in the last hour or so. US 10s at 158.03, largely range-bound. We had a monthly 20-year bond auction that drew lukewarm demand. Citi is joining Morgan Stanley in backing the bet on aggressive Fed hikes. They're recommending a June 22 to 25 Eurodollar steepener. They're saying that's where the next big profit is. New Zealand dollar. Quite a bit of upside here. Everything else in G10 FX is a slumber. That's why I'm taking you to this currency pair after the country's 2-year inflation expectations climbed to the highest level in a decade. And that's reinforcing bets for even more rate hikes. And then Brent crude, one of the big themes of the day, again down $80 a barrel at the moment. China saying it might release some of its strategic reserves, add more barrels to this market. Also, an investigation potentially in the United States on illegal conduct in the oil market. Let's flip it around now and get to the European story in a bit more detail. Looking here at stocks that are looking for a little bit more direction. A little change then after we had a record high, 6 consecutive days of gains. The jump in COVID-19 cases, keeping risk appetite quite muted, falling commodities weighing on the sector. Energy and miners are falling the most. There are some idiosyncratic stories like Metro Bank shares that are dropping 20% after the Carlyle talks were terminated. But with all of this in mind, the CIO at UBS Global Wealth Management just put out a note, which I read before coming on the show, and he sees further upside for Eurozone stocks because, in his view, the new coronavirus-related lockdowns don't look unlikely. Eurozone equities remain one of their more preferred regions. Valuations look undemanding. Well, with that in mind, investors are grappling with the risk that central banks may taper asset purchases and hike rates more quickly than expected to counter the price pressures that we're seeing everywhere in the world. The CEOs from the Bloomberg New Economy Forum in Singapore weighed in on the inflation debate.
I think inflation is getting to be a lot more structural for 2 or 3. Happens is when you start seeing sticker prices of 6 and 7%, that starts building inflationary expectations. And once inflationary expectations get anchored, then you get into the spiral. So I don't think it's such a temporary phenomenon.
I am concerned about inflation because I think at the same time as the supply chain recovering, there are some new issues. Supply chains are repositioning, partly because of geopolitics, partly because of resilience considerations by governments. Oil prices are going to remain high for quite a while.
When I step back and I think about my 40-year career, there have been periods of time when greed has far outpaced fear. We were in one of those periods of time. Given that it feels like inflation's rubbing above trend, chances are interest rates will move up. And if interest rates move up, that in and of itself will take some of the exuberance out of certain markets.
Joining me now to discuss all of this and much more is Mark Cudmore from Bloomberg Markets. He's an anchor and he joins us from Singapore. Mark, we're seeing Brent and WTI just taking another leg lower, Brent below the key $80 a barrel mark. I'm wondering to what extent, sustaining that kind of level or even lower levels could take the heat out of some of these CPI figures.
I think that's a great question, Youssef, because obviously this is providing a lot of relief for markets. We know that inflation is the big story, it's the big threat, and obviously that is primarily driven by commodity markets, and most recently the energy crisis, which is perhaps most intense in Europe. Now, we are seeing a little bit of relief in oil prices, mainly in yesterday's session, but it is feeding through today. Interesting enough, when China came out, at least that story came out saying China is considering also joining the US and releasing oil from their equivalent of the Strategic Petroleum Reserve, it didn't actually weigh on oil much further. We're pretty much unchanged since those levels, which kind of suggests to me that that story is largely priced. That relief that we're going to get from that any potential release from the Strategic Petroleum Reserve is probably mostly priced. It doesn't mean we won't get another knee-jerk move lower in the very, very short term if we get a headline, but I don't expect it can sustain. I think that overall we still have another bounce in this oil prices in the weeks ahead.
I was looking at one of the surveys from Bloomberg, and 21 forecasters looking at year-end targets for the S&P 500. Lowest number, 3,800. Highest number, 4,800. That is a spread of 26%, which is the biggest spread in about a decade. Where does the markets live team think we'll end up?
It's a great question. We're actually just about to do our year-end survey, running it out for clients in 2 weeks' time. I haven't polled the overall team. I think the general view from the team overall is that we still see some more upside in some global stock markets, but the value has gone from U.S. stocks. I mean, people might have said that for some time, but I think that certainly the risk-reward of being in U.S. stocks is much less appealing here. We know that there are stretched valuations. We know that the Fed is in a very, very tough spot. There is an inflation problem. That's not new to anyone. What we are trying to work out is the central bank reactions function. And because there's so much uncertainty around that central bank's reaction function, I think U.S. stocks are going to be a more difficult play. We had a guest in one of the earlier shows talking about how the idea that Chinese stocks may come back in vogue, even though the crackdowns there are not over. The fact is the discount is in the price there. There's a more exciting growth story. There's more potential upside. So I think if you're going to talk to the S&P 500, we're not particularly positive. We're not overly bearish, but we kind of think that that's not the risk-reward play. It's not where you get excited. People say there is no alternative, TINA, for buying stocks. It no longer means you need to buy U.S. stocks. You can look elsewhere around the world.
I was looking at what the New Zealand dollar is up to, and it's pretty much the standout on the global markets map in the FX column. You look at the 1 month vol from the JP Morgan surveys, and these numbers reach about 8-month highs. It tells you a story of ruptures, of dislocations as a result of the inflation expectations rising and the rate hikes that come with it. Where do you expect to see more of that kind of repricing to take place in the next few days?
I think we have more upside in FX vol overall. So the story of the last few months has been the idea that rates vols return to markets. That's because finally rate hikes or policy moves at the front end are back in play. And this is exciting for macro traders. So we've got rates volatility. That's been the theme of the last few months. Amazingly, up until the last week, we've seen FX vol stay very quiet. That's starting to change. Now it's happening. Now that people know that, hey, this inflation, it's not transitory, or at least it's not transitory in the sense that people were thinking about it a little while ago. It may end in 6 months' time, but it's not coming down as soon as people wanted, which means central banks are going to have to react to some extent. That means we're starting to get the path through to FX vol. I still think there's more upside in that kind of theme of FX vol catching up with rates vol, and I think into year end, I think there's going to be overall volatility in the equity market as well. So I think this idea of a permanently slightly more elevated plane of volatility from what we had 6 months ago is definitely valid.
Mark, thanks for that. I mean, I'm getting tired of this whole discussion around transitory. I just paid 4 times the regular price for an Uber here in Dubai. I mean, if anything, that is the story of the front lines of inflation. Mark Cudmore there, the Bloomberg Markets anchor from Singapore. Here's what's still to come on the program. More from the Bloomberg New Economy Forum. We've been speaking to the HSBC CEO, Noel Quinn, and we will get his views on the global recovery, inflation, and China. My colleague Francine Lacqua has made it back from her panel, and she's going to take over the reins again from Singapore. I'm jealous. This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore. I'm back. We had a fantastic panel talking about green financing. We're joined by Noel, Quinn, and of course the chairman of Tata Sons, as well as the chief executive of Macquarie. Now let's get straight to the Bloomberg. First word news in London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. Boris Johnson is said to have told a private gathering of Conservative lawmakers that he had effectively driven the car into a ditch after 2 weeks of negative news stories for his party. Shortly after the meeting, the House of Commons voted to adopt the UK Prime Minister's plan to tighten rules on second jobs for politicians. Opposition parties abstained in the vote, calling for tougher reforms. Now, the ECB's vice president says inflation should slow next year, but not as quickly as expected a few months ago. Louis de Guindos told Bloomberg that easing price pressures would prove the current bout of inflation is transitory. He also says he expected the ECB to raise rates for at least a year.
We will see what happens over the next months with the evolution of the economy, the evolution of inflation. But my personal view is that it's going to be quite unlikely to have a lift-off of rates in 2022.
Goldman Sachs is stepping up the expansion of its private banking team in London as it builds out its operations targeting the world's ultra-wealthy. The US bank has hired at least 9 private wealth advisors in the city this year from rivals including Barclays and Julius Baer. It's part of a strategy outlined by CEO David Solomon to make Goldman less reliant on trading revenue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, the strength of the global economy has been a key theme, of course, on the second day of the Bloomberg New Economy Forum here in Singapore. Earlier, we spoke exclusively with the HSBC Group Chief Executive, Noel Quinn, and we asked him about the US-China relations and, of course, the inflation debate.
The world's economy is recovering. It's recovering well. There are tensions in the supply chain. We shouldn't be too surprised by that. We went into fast reverse. We're now going fast forward. There will be friction in the supply chain for a period of time. But take it as a positive that the world is recovering and economies are rebounding. If I then look at the concerns for the future, I am concerned about inflation because I think at the same time as the supply chain recovering, there are some new issues. Supply chains are repositioning, partly because of geopolitics, partly because of resilience considerations by governments. Oil prices are going to remain high for quite a while because there's constrained supply. And the investment cost of new sustainable infrastructure is going to have a premium in the near term.
But do you worry about shocks or do you worry about monetary mishap? What does it mean for a big bank?
I think controlling inflation is going to be a fine art as opposed to a science. And I think we're going to have to make careful judgment calls in the central banks over the next few weeks and months as to how they keep the balance between economic recovery and making sure inflation doesn't get out of control. And I think they'll do that through pulling back on QE and progressive, gradual increases in interest rates. And I think countries will move at different times on that, and that's okay. But it's going to be about balance.
We just heard from the former Treasury Secretary, Hank Paulson, also saying it's almost impossible for the U.S. and China to decouple. Yeah. Like, how do you read the Chinese economy right now? And has HSBC rebuilt ties with them? Well,
listen, the Chinese economy has been big as a manufacturer of the world for many decades. It's also huge as a consumption market for the future. And I don't think the world can decouple from one of the biggest manufacturing nations of the world and what will be one of the biggest consumption markets in the world. So I really hope it doesn't decouple. Will there be differences? Differences in views on technology, differences in views on politics? Yes. But I think it's important that there is a level of connectivity between the world and Asia and between the US and China.
In general, for your wealth business, do you see, how many bumps along the road do you see? Do you see it like a clean trajectory upwards in terms of how you build and grow?
For us, it's continuous investment. We already start with a very strong platform in Hong Kong. We're one of the biggest wealth managers in Hong Kong. We have on our balance sheet over 1.6 trillion of assets under management, wealth assets under management for our clients, whether it's in private banking asset management, it's in our retail operations. Now, for me, it's about a continuous investment program. I guided the market that we were going to spend $6 billion over the next 3 to 5 years. $3.5 billion of that is building out our wealth business within Asia, and we're going to do that across all of Asia. I think there's wealth opportunities in Hong Kong still, China definitely, Singapore absolutely, and also India. Now, that will be a combination of organic investment, recruiting people, and as you've seen in Singapore, we bought a business, or are in the process of buying a business from AXA. Bring that business together with our insurance business, and we have a much more powerful wealth proposition here in Singapore. And I'm looking at 3 or 4 other opportunities like that as bolt-on acquisitions over the next few months across Asia.
Noel, have you spoken to Hong Kong authorities so that you don't have to do a quarantine next time you come back, as they rolled out the red carpet for...
I'm not planning a trip at the moment. I think it's important for Hong Kong to establish what they need to establish with China on reopening the Hong Kong-China border. I don't want to do anything that may jeopardize that. I would love to get back to Hong Kong as soon as I can, and when the authorities feel it's right for me to go back, I will do.
HSBC Group Chief Executive there, Noel Quinn, speaking to me a little bit earlier on. Of course, the focus was on controlling inflation. He said that controlling inflation is going to be a fine art as opposed to a science. Now, coming up, we'll be back live, of course, from here, Singapore, Bloomberg New Economy Forum, and we'll be discussing the surging COVID cases in Europe as the continent fights back. I'm looking forward to catching up with our chief economist, Tom Orlik. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore at the Bloomberg New Economy Forum. Now, several European countries are stepping up their fight against COVID as cases are surging. Germany is urging more of its people to get vaccinated. Belgium is, of course, reimposing work from home. And last week, the Netherlands entered a new partial lockdown. Now, all of this raises a prospect of economic pain in Europe and possibly beyond. One person who's sounding rather more optimistic about recovery next year, though, is Bill Gates. We caught up with the Microsoft co-founder at the New Economy Forum here in Singapore.
Well, the vaccines are very good news, and the supply constraints will be largely solved as we get out into the middle of next year. And so we'll be limited by the logistics and the demand. The idea that economic activity will resume in full once you get to flu levels, it's very likely.
Let's get more now on what's going on at the New Economy Forum with Tom Orlik. Of course, he's our chief economist at Bloomberg Economics and author of China, the Bubble That Never Pops. He joins me here at the forum, both jet-lagged, but he makes a lot more sense than I do. Tom, when you look at, first of all, China, I mean, we talk about, inflation. We talk, of course, about, they're firing up the coal plants, and we'll get to that in a second. But does the economy really depend on whether they stick to their zero COVID tolerance policy or not?
So you mentioned the surge in COVID cases in Europe, Francine. China, the situation is different. They don't have many COVID cases, but because the government is pursuing this zero COVID strategy, even a few cases can bring an entire town, sometimes even an entire province, to a standstill. What we're seeing as we approach the end of 2021 is that zero COVID strategy, combined with the energy shortages, combined with all the problems we're seeing at Evergrande and the real estate sector, that's really taking a toll on China's growth.
So what does it mean for the supply chain? We had talked about in the past that the fact that, we had a U.S. that was a little bit less friendly, certainly to multilateralism. A lot of the supply chains had already moved. Do they move further away from China? Can that even happen? Is it possible to move them away from China if they stick with this policy? Or this is, we have supply chain pains for quite some time to come?
So one of the big themes which people are talking about here at the New Economy Forum is supply chains and that interaction between supply chain snarl-ups and inflation. And some of the messages we've been hearing from the big bankers here, and today from some of the big corporates, we heard from Cargill, the agricultural giant, from Bayer, the life sciences giant, they're concerned that these supply chain snarl-ups, exacerbated by shortages of workers, they're not going to go away immediately. And what that could mean is that the problem we're seeing with high inflation right now, well, that could persist into 2022.
Great, Tom. Thank you so much. We'll come back to Tom Orlik, Bloomberg Economics Chief Economist, and we'll talk a little bit more about foreign relations. Who's your star speaker?
It's got to be Henry Kissinger.
Yeah, so we'll talk a little bit about what he said, U.S.-China foreign policy, and of course some of the pitfalls if we don't go into a more multilateral world. Now, coming up, we'll focus a lot more on foreign policy. One of the key themes here at the New Economy Forum is, of course, how the U.S. deals with China, whether there's this supremacy race to actually be the biggest and more powerful country, or whether there's going to be a lot more coordination between the two superpowers. This is Bloomberg. Europe grapples with its worsening winter COVID outbreak, while Germany pushes for more people to get vaccinated as Belgium reimposes work-from-home mandates. Amazon takes the Visa feud across the Atlantic after its UK card ban. The retail giant is now considering shifting its popular credit card to MasterCard in the US as well. And more top interviews right here from the Bloomberg New Economy Forum in Singapore. We'll bring you our conversations with Bayer's chief executive and Singapore's prime minister. So good morning, everyone. Good afternoon if you're watching from Asia. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore. Now, we had some wonderful conversations over the last couple of days. Of course, tensions over Taiwan, one of the critical points that we've been trying to figure out. They risk leading to miscalculations between the U.S. and China. At least that's according to Singapore's prime minister. Well, he spoke last night with our Bloomberg editor-in-chief, John Micklethwaite, here at the New Economy Forum in Singapore.
First, I would try to move on trade. You can't do an FTA, but you do want to move forward on trade, even despite the Democratic Party roots. Secondly, to develop the relationship with China, because if that relationship is sour, it's much harder for every other country in the region. Thirdly, don't stop with China. Also cultivate your other friends in the region and allies. And I think the second part Biden is trying to do, it's a long journey, but he's starting. The friends and allies, his approach is quite clear, and I think people do believe that. The last thing he can do is to ensure the president after 2024, whichever party of like mind.
That is sadly not in his...
It's not within his giving, but that is something which is very important. You must be able to look beyond, because America's interests extend well beyond 2024.
One last question on that is Taiwan. How much should we worry about what is going to happen there?
I think we should be concerned. I don't think it's going to war overnight, but this is a situation where you can have a mishap or a miscalculation and be in a very delicate situation. The leaders, the countries all say the right things. In this virtual summit this morning, Joe Biden said, well, the U.S. will uphold its one China policy, and he also talked about the Taiwan Relations Act, which is long-standing. Xi Jinping said, we are not in a hurry to solve the cross-straits problem. Yes. It's a code word, but everybody knows what he means. And in Taiwan, Dr. Tsai Ing-wen says, we ask everybody to maintain the status quo. So everybody says the right thing. But if you look at what is happening, it is not a static situation. The US has significantly increased the visibility, the level, and the intensity of engagements, diplomatic engagements, even military engagements with Taiwan. China has been testing Taiwan's air defenses. It flies aeroplanes into Taiwan's air defense identification zone almost daily. It doesn't intrude into its sovereign airspace or its immediate airspace, but it's testing Taiwan's defenses and tightening up on international space, which was prepared to concede Taiwan even 5 or 7 years ago. And on the part of Taiwan, this DPP administration has disavowed the 92 consensus, which was to each its own interpretation, and it says, no, that's not an acceptable formulation. And taking other steps, for example, printing on their passports in English, Taiwan passport. So all these moves raise suspicions and tensions and anxieties and make it more likely that a mishap or miscalculation can happen.
Well, that was Singapore's Prime Minister speaking there with our editor-in-chief, John Micklethwaite. Now, to talk more about, of course, foreign affairs and the impact this has on the economy, our Bloomberg Economics chief economist, he is Tom Orlik. Tom, you're a great student. Thank you so much for sticking around, first of all. But you're a great student, of course, of foreign affairs and how they relate into, economics on the long term. So we had this rapprochement. There was a lot of talk, especially here in Singapore, about the Xi Biden meeting lasting 30 minutes longer. So that meant they get along and maybe we could have progress. What does that mean for, first of all, the individual economies, but also the world economy as a whole?
So the story on US-China relations over the last 5 years, from the start of the Trump presidency, has been a story about risks and economic costs. Tariffs, sanctions, embargoes, all of this has hit individual companies, it's hit markets, and ultimately it's hit growth and jobs. The hope here, I think, in Singapore, in the wake of that Xi-Biden meeting, with Wang Qishan, China's vice president, speaking here at the NEF and committing to China's continued reform and opening, I think the hope is not that things are going to improve, the tensions are still there, but rather that some of the diplomatic guardrails have come back on and the relationship is now going to stabilize.
But so that means what, cooperation in certain fields? Or does it actually mean that, for example, we could see a commitment on climate change or something more, for example, on the energy crisis?
So COP26, we already had that commitment from the US and China to do a little bit more together to address the world's biggest challenge, which is climate change. Can they go further than that? Can they do something on trade? Could we see tariffs start to come down? From where I'm sitting right now, that still looks like a stretch. I
need to talk about inflation and the Fed chair. So first of all, on inflation, where are we? Do you believe, what does a policy mistake look like? Do you believe actually central banks and saying, look, let's not call it transitory, but it will come down quite significantly? Or do you think that now is the right time for central banks to act?
So it's a complicated story on inflation, Francine. Certainly the transitory narrative that we heard over the summer, that was way too optimistic. US inflation now at 6.2%, 30-year high. We think it's going to climb higher into the end of the year. Looking into 2022, though, it's really difficult to see inflation sustained at the current high levels. The base effect is going to disappear. It's difficult to imagine energy prices continuing to add as much to consumer prices as they are right now. So I think we might be close to peak panic about inflation. And I think that means we might also be close to peak expectations in terms of how aggressive central banks are going to be on tightening.
Does it matter to the world economy? I know it matters to the traders. I know it matters especially to the bond traders, gilt traders. But does it matter to the world economy if we have, tapering or even a hike 3 months before than expected?
So the taper, we think, is going to run until June of 2022. The Fed's been pretty clear that they won't continue with asset purchases and hike interest rates at the same time. Those are kind of opposite forces. Buying assets adds stimulus, raising interest rates takes it away. So we don't think it's plausible to imagine a rate hike before the taper is completed. And we also don't think it's likely that the Fed will accelerate its taper. The risk, if they did so, would be a repeat of that taper tantrum, which did all of that damage back in 2013.
Tom, massive kudos, actually, because when I spoke to Andrew Bailey, when he disappointed the markets and the markets kind of fell out of bed because they didn't raise rates after talking up the markets, he said, but Bloomberg Economics got it right, so maybe more people should actually read your research. Is there a belief in the markets, and this is something that I explored with David Solomon yesterday, that they will always go up? So is there a disconnect between which we could see in central banks and we could see in the economy and actually what markets are looking through?
Kudos on that Bank of England call to my European team, Francine. I unfortunately take no responsibility for it. Well, it's very kind of you. So I think this is a challenging moment. We have really high asset prices, equity prices very elevated, property prices very elevated, commodity prices very elevated, and yet central banks now beginning to move towards a normalization of policy. Bank of England very likely to move on interest rates soon. The Fed very likely to move in the second half of 2022. And that combination of extremely elevated asset prices and the beginning of normalization in monetary policy in the US and elsewhere, clearly that's a challenging confluence of circumstances.
Tom, thank you so much. Tom Orlik there, Bloomberg Economics Chief Economist. Tom Orlik joining me here in Singapore at the Bloomberg New Economy Forum. Now, coming up, we'll be speaking with the Chief Executive of Moe NSE, the conversation live from here. It's a conversation, of course, about gifting. China and the US are two biggest markets. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore. Now, let's get to another one of our top interviews here at the New Economy Forum. We're actually discussing luxury drink sector. Well, key names of the industry have been posting bullish outlooks for the post-pandemic growth amid reopening and new consumer habits. Now, Moe NSE is the luxury drinks unit of LVMH. They make 28 million bottles of champagne, 28 million bottles, I'm going to say it again because I couldn't quite believe it, per year, and have been around since 1743. Now, it represented around 10% of the conglomerate's revenue in the first 9 months of 2021. Now, joining us now is Philippe Schaus. He is the Chief Executive Officer of Moe NSE. Philippe, thank you for joining us. I mean, we're going to have a great conversation on what people are drinking, what they're not, and their changing habits. But first, the number of bottles that you sold is absolutely incredible. How hard were you hit by the pandemic? Did people drink at home, or did they just drink less, full stop?
Well, we had a drop in last year in 2020, when all the restaurants and bars closed down. And so we're quite uncertain about what would happen. And then since the middle of last year, we saw, as bars were reopening, people coming back, as people were ordering from home, as our e-commerce activities were picking up. We saw people really coming back, and then this year has been very good. So we are really finishing, it looks like we're going to finish this year ahead of 2019.
If you look at the US and China, these are your two biggest markets, and certainly China's gifting, but it's also the premium brands, especially from abroad, that they love. Has any of the consumption changed, and do you see that changing in the next 2 to 3 years?
So what we've seen in almost everywhere in the world has been an upgrading of the consumer in terms of his choices for alcohols and drinks. So we have seen people really coming back in consumption, moving up from that level to this level, and our brands have, of course, benefited from that. Now, between China and the US, it's a bit different. The US is a lot about cognac, of course, Hennessy, especially the more entry-level Hennessy, VS, and then about champagne, a lot of champagne in the US, and also about Chandon, and about our new Volcan Tequila, and our Glenmorangie whiskies, and Artback. And the China, conversely, is a lot about XO, Hennessy, which is the high-end Hennessy, VSOP also at that level, and then it's about whiskey, but not so much about champagne.
Have you been able to raise prices? Have you had to raise prices because of supply chain issues?
We have raised prices, but not because of supply chain issues. We raise every year our prices as to, we are selling limited products. We have limited quantities.
It doesn't impact demand. Does it impact demand?
No, it doesn't really. If you do it on a reasonable way, on a year-by-year basis, we have what we produce, whether it's champagne or cognac, is based on limited land, on limited number of grapes, and so it's every year there's a renewed effort to elevate further the quality, and that leads, of course, to higher cost as well, and that leads to higher prices.
Philippe, talk to me a little bit about COVID restrictions. So, a few of us had a drink of our choice at a bar, perhaps yesterday in Singapore, but actually they closed everything at 10:30, and that has been since the pandemic and since COVID. How much sales do you lose because of some of these restrictions? So not complete lockdowns, but just authorities being much more careful until how long people drink.
Yeah, you had some losses be it in US, be it in Europe. It was some losses, but it was in most cases overcompensated by the fact that people were consuming more at home. And when people consume at home, they tend to go more high-end again, because, of course, the bottle is cheaper in a liquor store than when you drink it in a bar. And so in the end, the overall effect has been rather positive for us.
When you look at climate change, you're really at the forefront because you're affected by grapes. We had a huge amount of grapes in France being affected by a pretty harsh winter last year. Is there anything that you can do to try and mitigate it?
Yeah, there are two aspects of climate change. One aspect is what do we do about our own influence on climate change. So we are working on our energy consumption. We are working on biodiversity. We are working on reducing packaging. We launched, for instance, with Rina, we launched a recyclable, very simple packaging on the Rina bottle. These are efforts on transportation, so moving away from airplanes, doing everything by ship, and even sometimes with sail ships. We have a project going on. So that's our own impact on what we do on our CO2 impact. Yeah. On the other side, of course, in our vineyards, there is an impact of climate change. Is an impact on water, and there's an impact on temperature. And I just inaugurated a research center, which we opened up in Champagne, where we invest about 30 million euros for a big research centers, which has one of its main focuses will be what is the impact of climate change on our vineyards throughout the world, and how do we change some ways of doing, so do we progressively adapt to a warmer climate and continue to make the best, the highest excellence in terms of winemaking in the world.
Are you also most expensive? I was going to actually ask you about taste, Philippe. I have so many questions. You're stuck here
Go
for
ahead.
the rest of the day. Have our tastes changed? So with time, do we like sweeter products? And do you do actually research on what people want to drink to make sure that it's calibrated to the sugar level that they want to drink?
No, I think the over the long term, has been rather going to a little bit less sugar. Over time, and so that is rather the trend. So
diet reasons or really taste?
I think both, probably. A Champagne Brut, like the Moitié Chandon you showed earlier, doesn't have that much sugar. We also launched a spritz this year, Chandon Garden Spritz in many countries, and that has half the sugar of comparable products in the market. So sugar is rather going in our products on a downwards trend. Are tastes changing? Not really. I think, of course, more and more people are experimenting with higher end champagnes and wines and are becoming more sophisticated in the tastes. And so we are benefiting from that, but that's more a kind of elevation of sophistication than anything else. So.
Philippe, thank you so much. So if I invite you over and give you Prosecco, you'll never come on Bloomberg again. Is that right? You don't even want to comment. Let's not go there. Let's talk about the markets. Philippe, thank you so much. Philippe Chaus there of NSC. Now let's get straight to your Bloomberg Business Flash. In London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. India's largest digital payments provider has lost more than a quarter of its value in its first day of trading, heading for one of the worst ever debuts by a major tech company. The 26% plunge in 197 communications operator of Paytm surprised even some skeptics who had questioned the company's valuation. The offer was India's biggest ever IPO. Now, Cisco has given a lackluster revenue forecast for the current period, blaming supply chain issues for component shortages. The world's biggest maker of computer networking equipment says it's expecting sales to increase by a maximum of 6.5%, half a percentage point below forecast. Cisco is trying to reduce its reliance on hardware sales and boost offerings of software and internet services instead. Nvidia has given an upbeat fourth quarter forecast fueled by its expansion into data center chips and other markets. The chip giant expects revenue to hit $7.4 billion during the period, more than $500 million above estimates. Nvidia has averaged about 97% revenue growth over the last 8 quarters, pushing its market cap way beyond Intel's. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, coming up, we'll be talking about Amazon's split from Visa over transaction fees. We'll be talking, of course, to our banking editor in London about that and, of course, the impact this has on some of these credit cards. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore for the Bloomberg New Economy Forum. Now, simmering tensions have led Amazon to consider ditching Visa and shifting its co-branded credit card to MasterCard. Now, the news follows yesterday's story that the online giant is stopping Visa credit card payments in the UK from next year. Now, Amazon blamed transaction fees, but Visa says they believe that they can rescue the relationship. Let's get more on this. To discuss the split is Bloomberg's Tom Metcalf. Tom, I'm not going to lie, a disclaimer. disclaimer. As soon as I read the news, I went into my wallet to check whether I had a Visa or a Visa or a MasterCard. But is this just a negotiating tactic by Amazon because Visa just can't let them go?
Yeah, exactly. And I think your experience is probably what a lot of people were doing yesterday. I mean, extraordinary. So anyone with a Visa credit card in the UK would potentially no longer be able to buy anything from Amazon from, I think, January the 19th. So, yeah, I was speaking to a few payment executives, and they are basically saying, if you take the cynical view, this may just be Amazon trying to, knock a few percentage points off the fees it pays to Visa. But there is kind of a bigger issue here. This has been a multi-year global fight between big retailers and folk like Visa and MasterCard. So the question is sort of how far does this go? Right now, the news is really in the UK. But what about in other markets? You're in Singapore right now, and I know Visa have introduced a surcharge there. Amazon have introduced a surcharge there. So does this start to spread to all the other markets, or will it stay, kind of within the UK?
I mean, the story, I have to say, is absolutely amazing. So let's say, Tom, that Amazon actually does split from Visa and the ban comes in. What would it mean for the payment processor as a whole? Do regulators step in because Amazon is so big? Like, where do we go from there?
Yeah, I mean, it's fascinating. It speaks to just, how dominant, say, a Visa is, that this would be a big issue, because I think Visa and MasterCard have about 98% of all processing at the moment. So if Amazon said, we are not accepting Visa credit cards, that would be, kind of really upend the ecosystem. Difficult to say, whether that will happen and what it would mean. But taking the UK example, Barclaycard, one of the biggest credit card providers out there, that's a Visa operation. So I'm sure what happened yesterday is folk at Barclaycard were pretty frantically calling up Visa and going, whoa, what can we do?
So Amazon, right, in general, believes that card fees should be getting lower with progress, not higher. Also because we have so many entrants that, have lower fees. Do they have a good case to lower the fees that credit cards charge in general?
Yeah, so tensions have definitely been rising between all retailers because they do feel Visa and MasterCard both are basically raising fees. So you've sort of seen that both in the UK but also in the US, particularly during the pandemic, where both Visa and MasterCard told retailers, look, we're going to raise the interchange fees. It's effectively what happens every time you swipe a card on stuff like e-commerce transactions. So that's really kind of sparked this latest, I guess, salvo in this long-running battle. And it's really who you speak to, right? Like Visa and MasterCard say, hey, we're essential. We're just trying to make sure the business runs smoothly. And retailers are saying, you're gouging us. And it's going to be a big, long-running and painful battle, I'm sure.
All right, Tom, I know you'll completely stay on top of it, so I'm looking forward to reading all of your coverage and your team's coverage. Tom Metcalf there, Bloomberg News from our banking team. Now, in the meantime, this is what we're seeing in the markets. Let's have a look at the U.S., but also let's have a look at what Amazon, Visa, and NVIDIA is doing. Now, overall, it's true that Asian stocks were actually down. We saw a tumble in Chinese technology shares, but it's not really filtering through pre-market Visa, getting some 0.4%. More Bloomberg next.
People feel the pinch of inflation and cost increases when they go to the store, when they go shopping and the like.
Some of the capabilities the team has built over the last several years, to use the ports example, operating 24/7 in the ports, that's something we've been doing as a retailer for quite a while now.
The idea that economic activity will resume in full once you get to flu levels, it's very likely.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, November the 18th. Our top stories today. China takes a shot at rising oil prices. Crude falls after Beijing says it's releasing oil from its strategic reserves. Relations between the US and China take center stage. We'll have the latest from the Bloomberg New Economy Forum in Singapore. Plus, Bill Gates predicts COVID deaths could fall below seasonal flu levels next year. But there's a catch. We'll hear from the billionaire co-founder of Microsoft. That coming up. Welcome to the programme, everybody. I'm Anna Edwards, live in London with Tom Mackenzie here with me. Matt Miller, of course, in New York. Kailey Leinz is off this week. And Matt, a host of topics then on the agenda, firmly on the agenda for us in Singapore at the New Economy Forum, from COVID recovery to the supply chain issues, all that still very much in the mix. For markets, though, a little bit of move to the downside in Asia, but things look brighter for the US.
Yeah, a little bit of a mix in markets as well. I noticed that people are pretty positive about the COVID situation at the BNF Forum. On the other hand, in Europe, the situation looks like it's deteriorating. In Asia, we have stocks that are down. The MSCI Asia Pacific, you can see, down about 1/3 of 1%. They're doing worse in Hong Kong than they are in Japan. That's because it's really the Chinese tech stocks that are weighing on the index, while in Japan, they're happy about an almost $500 billion stimulus package, and that has cut the losses that we saw earlier in the session. The yen right now is a little bit weaker against the dollar. You can buy more than 114 yen for the dollar. But the Bloomberg Dollar Index is actually coming off. We've seen the Bloomberg Dollar Index at an almost one-year high, rallying over the last couple of days. It's taking a little bit of a breather today. So up against the yen, but down against other major currencies. Take a look at what's going on in Europe, where we're at near record highs in Europe we are at near record highs, but I'm going to leave that for Tom Mackenzie. S&P futures are up a little bit right now, about 0.25%, and European stocks, I think, are following along with that. The 10-year yield is up right now, 159.58, as investors feel comfortable enough to let go of the perceived safety of government bonds. Gold letting off a little bit, just $341 a troy ounce, and Bitcoin down about 1.1%. The elephant in the room on this screen, maybe I should say, is crude oil. I left it off because Tom Mackenzie's going to hit on it, but this is one of, I think, the biggest issues in the markets today, Tom.
It's an absolutely fascinating topic as well. We'll look at the pricing action shortly, but the fact that this comes just a couple of days after that meeting between Presidents Biden and Xi, and now the Chinese are saying, yes, in fact, we are going to release some of our strategic reserves. Let's see how things are mapping out then across the European region. You were saying, Matt, that we were up. We've actually we're now flat, but you're right. We are seeing gains of about 0.1%, but things have turned more negative now across the session here in Europe, weighing up, of course, those inflationary risks, but also, and you touched on this, that rapid rate of COVID infections, particularly countries like Germany, record rates. Belgium putting in new policies, mask mandates, work from home. The UK is lower on the back of basic resources and energy. The DAX had been up 0.3%. It's now lower in the red. The CAC 40 is just holding on to gains of 0.2%. You're seeing gains over in Spain of 0.2 as well. Let's switch it on and look at some of the cross assets then. You're talking about the dollar, the pound and sterling in focus. It's currently flat, just eking out further gains, but it's had its biggest session, longest run since about April, on these increasing bets that you will see a hike by the Bank of England in December. The inflationary picture here and the wage growth and jobs picture, that is positive and building in to that determination that you're going to see a hike in December. The European Stoxx 600, now the benchmark, just eking into the red. And in terms of that crude story, down 0.5%, so comfortably below the $80 a barrel. Again, on the back of this reserve release by the Chinese side. We'll see if Biden follows through, but that is a fascinating picture and dynamic in the energy space. Iron ore also lower, down 3%. Vale, one of the biggest producers, coming out saying they actually see a stable market next year.
Yeah, really interesting to see those moves then on oil prices and on iron ore, basic resources and energy, the biggest losing sectors here in the European market this Thursday. Let us take a moment to think about what lies ahead today then. And we have corporate earnings still to come. Alibaba's share price recovery faces a really big test today, with the company's third quarter earnings expected at just before 7 a.m. New York time. Turkey's central bank will announce its latest policy decision at 6 a.m. New York time. President Erdogan has made it clearer than ever, really, that he wants lower rates. He did that about this time yesterday. We got those red headlines across the Bloomberg on that very subject. The central bank is expected to deliver on lower rates today. And Biden will host the Mexican president and the Canadian Prime Minister at the White House. He is expected to hold a news conference after the meeting. North American trade, no doubt, in focus there. Now, getting back to one of our top stories, China is releasing some oil from its strategic oil reserves. That comes just days after Xi Jinping and President Biden met and discussed the merits of releasing oil during their virtual summit. Jack Fitzpatrick, Bloomberg government reporter, joins us now from Washington. Jack, so what is the significance then of China
saying that they're going to be releasing these reserves now, just very much in the wake of that bilateral meeting between the two leaders.
Yeah, the significance of that is that it's a follow-through on a seemingly positive conversation that President Biden and President Xi had in their virtual summit on Monday. The Chinese officials have not yet given details on volume and timing of the release, and also we don't actually know for sure that this would not have happened without that conversation happening. But it is a follow-through from the Chinese side on a conversation that came up in that joint virtual summit on Monday. We also do have to see if the U.S. follows up on this. There's been some positive feedback on a strategic petroleum reserve from Chuck Schumer in the Senate, but House Majority Leader Steny Hoyer said he does not like that idea. So Democrats are not all entirely unanimously on board, and there may be some pushback. But as of now, this news is basically a positive follow-up on that discussion that happened between Presidents Biden and Xi on Monday.
Yeah, important context there, Jack. We also heard from former Treasury Secretary Hank Paulson, someone who's got deep experience of China, warning that the world is headed for a dangerous place if tensions between the US and China get worse. Paulson spoke at the Bloomberg New Economy Forum in Singapore.
We need much more certainty around how the U.S. and China are going to compete, where they're going to cooperate, and how they're going to manage conflict. Otherwise, the world is headed for a very dangerous place.
Jack, so that was the former Treasury Secretary Hank Paulson, again, someone who spent a lot of time on the ground in China over the years, is close to Wang Qishan as well. What do you make of this commentary? How aligned is Hank with those hawks now in Washington on the question of China?
That is basically a prevailing view here in Washington, really with members of both parties on Capitol Hill, certainly, that there's a lot of risk to the U.S.-China relationship if there's any sign of stability. I think further context on that, obviously, is the news this week that President Biden sort of slipped up and used the word independent when referring to Taiwan and had to walk that back and say that this was not a statement of U.S. policy regarding Taiwanese independence. So obviously on the sort of military front, there's plenty of risk, but also just the fact that the U.S. and China are two major economies, not necessarily always headed in the same direction. Any good news or even lack of news can be a positive thing in terms of U.S.-China relations, as long as it's not a slip-up on Taiwan or something along those lines like we've seen this week.
All right, Jack, thanks so much for joining us. Jack Fitzpatrick there of Bloomberg Government. Simmering tensions have led Amazon to consider ditching Visa worldwide, shifting its co-branded credit card to MasterCard. The news follows yesterday's story that the company is stopping Visa credit card payments in the UK from next year. Let's get more on this with Bloomberg's Tom Metcalf. So, Tom, is this just a negotiation tactic by Amazon? Do they just want Visa to lower their fees?
Yeah, I think that's probably a fair analysis. They're looking to sort of throw their weight around. You know, it's one of the few companies out there that can really go toe-to-toe with a company like Visa. But it'd be very interesting. These kind of things normally take months to sort of unravel, and Amazon is saying, hey, we're going to stop these Visa credit cards in the UK from January the 19th. So the clock is ticking to see if, maybe a resolution can be reached. And if not, it really, drastic changes in the UK payment landscape if it goes through.
Yeah, Tom, good morning. What does this tell us about how payments and the payments industry has evolved and is shifting, and the various methods of payment that we have as consumers now? Used to be just about credit cards online. Now there are a host of different options.
Yeah, exactly. I mean, you've got to look at it in the backdrop of the pandemic as well, and a lot of payments kind of shifting online even more than before. So someone like an Amazon has a huge heft in this space. And then, of course, as an event yesterday where they said, this is absolutely fascinating, and folk like Visa and MasterCard are now in a sort of ecosystem where they are getting attacked from all ends. There's other options out there now with sort of direct-to-consumer type payment methods. So it's all up in the air, and it's just a fascinating time to be looking at it.
All right, Tom, thanks very much. Tom Metcalf there talking to us about the continuing developing Amazon story dealing with its payment providers. Now, oil took a fresh hit, extending a retreat from a 7-year high in October. This as investors brace for the possibility of a coordinated release from strategic reserves in the U.S. and other nations, most importantly, including China. Let's get more with Will Kennedy, our executive editor for energy and commodities So does it look like Biden and Xi are going to work together on this?
Well, it does, actually. So we reported yesterday that they were preparing, they had talked about a coordinated release during their virtual summit on Monday. They both agreed that they wanted to keep energy costs under control, and they both agreed that a release was a way of doing that. And then today, the Chinese government said that it is indeed preparing for such a release. That will be seen, I think, as a win for Biden and his efforts to keep energy costs under control. And I think the next thing the market will be looking for is the announcement from the US that a release is coming there. Yes.
Will, does this put the nail in the coffin of Goldman's $90 call on Brent?
I wouldn't ever want to say what the price is going to be. You just don't know, Tom. But what I would say is I think it's noticeable that since the OPEC meeting at the beginning of the month, where Biden's calls for more oil was rebuffed, he's continually tried to talk the market lower. The administration has floated all sorts of actions, including a release, but also possible export restrictions, possible changes in refining mandates in the US. And it's working. It's kept a lid on prices. The market can't go higher because they know that these threats of stockpile releases and other actions are hanging over them. And it seems to have pretty much capped US oil prices at that $80 a barrel for the time being. Now, the problem that Biden is going to have is, some of these things you can only do once. The release you can't do too many times because your stockpiles be drained. So for the time being, it's working. Longer term, I think the outlook's a bit more uncertain because the balance of supply and demand looks very tight.
Sure, only a short-term solution. Will, thanks for joining us. Will Kennedy there, executive editor for Energy and Commodities, talking about the potential SPR release, coordinated SPR release. I think one of the most interesting market stories of the day. But there are so many interesting stories on the corporate level in the pre-market. Take a look at NVIDIA shares right now, up 6.25% in the pre-market. NVIDIA said yesterday after the close that they think $7.4 billion of revenue is possible because of data center sales. There's a boom in data center chips. The street was only looking for $6.9 billion, so that's better than anticipated. As a result, NVIDIA, Qualcomm, some of the other chip makers are doing quite well. Meanwhile, Cisco is doing poorly in the pre-market. It said that sales in the current quarter are going to be growing about 4.5% to 6.5%. So at most 6.5%. Because of supply chain constraints, and the street was looking for 7%. So Chuck Robbins, Cisco down 7% in the pre-market right now. And then finally, Lucid and Rivian. These stocks have been at the top of the volume list. I look at most U4 to see the pre-market movers, and every day on the top of the volume list, Lucid and Rivian, although Lucid trades 3 to 4 times as much as Rivian in the pre-market. Both are down a little bit today, but they have soared. I mean, this is an $85 billion company. Rivian's worth $130 billion. So it looks like traders are looking to take some profits, Anna.
Yeah, I was going to say we're not used to this kind of volatility with auto stocks. And then I thought, well, maybe these days we kind of are. Now, coming up on this program, growing inflation risk, we'll discuss the investment outlook with Seema Shah, Principal Global Investors. Also get her take on that weakness in oil prices. We're seeing a lot of talk about SPR releases. It seems to be weighing on prices. And could COVID deaths fall below seasonal flu levels? More from our interview with Bill Gates ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards and Tom McKenzie in London. Now, Ven Ram has written such a good piece on the MLive blog that it could put all of us out of a job. It's just so succinct and makes so much sense that you don't really need to discuss it any further if you're looking to invest in markets. Nonetheless, we'll do that. I'm assuming that you haven't read it. He points out that valuations are strong, and we're also looking at dividends that have really nowhere to go but downhill right now. Corporate profits are expected to continue growing. The only problem, the wrench really in the works is, or the biggest problem, I should say, is the fact that central banks are going to have to address that kind of earnings inflation with rate increases. And we expect, at least the market is pricing, more than 2 rate increases for the U.S. over the next year, more than 4 rate increases for the U.K. over the next year. That could bring the house of cards tumbling down. Ven joins us right now, currency and rate strategist from the MLive blog. So, Ven, what are the chances that we actually get rate increases from these central banks at such a precarious time for the global economy?
Morning, Matt. First of all, let me disabuse everyone of the notion that I'm putting anyone out of a job. That's not happening. Talking of central bank rate increases, I do think that that's definitely a prospect for next year. Definitely from the BOE, Bank of Canada, and the Fed. But I think where the markets are kind of going wrong is in kind of the over exuberance in pricing in some of the markets, at least. In the US, they are factoring in 2 rate increases, which kind of squares with what James Bullard said earlier this week. But if you look at Europe, it's a completely different story. The markets are thinking the BOE is going to be raising rates like 100 plus basis points over the next 1 year. I don't think that's going to happen at all by any stretch of imagination, even under the most hawkish scenario. Likewise, they are factoring in about 10 basis points of rate increase for the ECB. But Christine Lagarde has already said that that's not going to happen, and that also flies in the face of sequencing. Sorry.
Ven, does this just reflect, good morning, by the way, does this just reflect a different relationship between central banks and markets in different parts of the world? Because certainly in the aftermath of the November confusion around the Bank of England, a lot of people have been writing about how maybe the Bank of England sees itself with a different role. Maybe you can apply this to other parts of Europe as well, giving market commentary, but not necessarily seeing its job as to steer the market. Whereas in the US, there is much more of a sense that the central bank should give a steer to the markets.
Absolutely, Anna. I think that a lot of that mispricing comes down to the communication issue. And as you know, Powell and his team teed up the taper so well that the markets, when they actually announced taper, the markets didn't really budge a whole lot. And that's why you see that pricing that is measured in the case of US. But in the case of UK and Europe, because of the communication issues that we have had, the markets don't really want to price the tail risk. But I do think that any tail risk is going to be on the dovish side, not on the hawkish side.
Then what does that mean then in terms of greater and more acute divergence between the central banks, particularly of the US and Europe, and how that reads across to the credit markets?
Well, I think that, you're going to see a lot of that spill over into the FX space already. And we are seeing that already. The euro has stumbled, like the euro index has stumbled like 5% in the past few months alone. And that's a pretty sharp drop in such a short span of time. And you see that rippling across through to the other currencies like the Swiss franc, which is appreciating contrary to what you would expect given the surge in yields. So I think that there's going to be a lot of spillover, whether it's into FX or into credit.
Ven, thanks so much. Thanks for your time. Ven Ram of the Bloomberg Markets Live team. Thanks to Ven for joining us. And you can get further market analysis. Check out MLIV Go on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Tom McKenzie in London and Matt Miller in New York. Kailey Leinz is off this week. And Tom, things fairly range-bound when it comes to the European session today. We're pretty flat on the stock 600, either side of the flat line. The Markets Live team, though, putting out a really interesting piece and chart and really interesting narrative around how stocks have so far enjoyed rather than feared the higher inflation story. So just as inflation has moved higher in recent weeks, we've seen stocks also moving higher. You just have to wonder how long that relationship lasts.
So the earnings story is obviously something that analysts are looking at as a supportive factor going into 2022 and the pricing power of some of these companies. But we saw the flip side of that with Target and Walmart, where their margins squeezed. They weren't wanting to pass on that pricing power. So we'll see. It was interesting that Citi now is aligned with Morgan Stanley in pricing in a more aggressive rate hike cycle, and whether that changes the dynamics in what is continuing to be a bull market, even as in today's session you've paired some of those earlier gains in Europe.
Does that change any of the Tina arguments? There is an alternative around stocks. Matt, US stocks, though, look as if they're pricing in something more to the upside at the start of trade. Europe here fairly flat, fairly dull at the overall level, but the US equity markets look set for some positivity.
Yeah, it does look like that, and I should point out, obviously the stock 600 is still near a record high, so it's doing pretty well. The S&P 500 near a record high as well, and you can see futures up about 0.25% right now, 46.98. Stock 600 is at 490 right now. The 10-year yield is coming up a little bit in terms of the yields. That means the price is down a little. Investors are willing to let go of that kind of protection, and maybe they're going to use the money to get into stocks. Maybe they're going to use the money to buy Bitcoin, although I should point out crypto is down today. They're definitely not using it to buy crude. You can see we continue to drop. NYMEX WTI down to 78 even off 36 cents a barrel, and the global benchmark Brent is also down today. The interesting stories, I think, are really on the corporate level. You've had a couple of profit warnings and a couple of forecast raises. NVIDIA, for example, says it can now make $7.4 billion in this quarter. Analysts were only looking for $6.9 billion. And the reason is this company, by the way, started out in chips used for video game consoles and now is doing chips for everything. But it's the data center growth that's helping it. As more and more people get into the cloud, more and more people are going to need chips or businesses are going to need chips to put them there, and NVIDIA is making them. So NVIDIA growing, it's the biggest chip maker in the world, by the way, by market cap, worth about $800 billion. Cisco, the router maker, is down right now. Chuck Robbins' firm said that they'll only boost revenue by 4.5% to 6.5%. Now, the street was looking for a 7% gain, but if they hit the low end of that range, it's going to be way off. As a result, the shares are down in pre-market trading. And then I showed you Lucid before. Rivian is also off just 3.5%. It's still amazing the market caps that these companies have. Lucid is worth $85 billion. They've never sold a car in public. Rivian has sold a couple hundred of its trucks, and it's worth $130 billion. So it's a Volkswagen-sized market cap, even though Volkswagen sells 10 million cars a year, and Rivian has sold like 250.
Yeah, really interesting. We were having these conversations around Tesla many years ago, weren't we? Now we're having them around some of these other newer names in the US. And interesting on NVIDIA, Matt, what you have to say there. I mean, they started out making chips for games. Now, if life is becoming a game, I'm talking about the metaverse or the omniverse, as NVIDIA talks about it, then maybe that plays well to their strengths. Let us get back to one of our top stories then, Matt, and that is around oil prices. For our radio listeners, I'll just describe what I'm looking at here in terms of this chart, this G chart that we have in the Bloomberg TV library. This is the extension of declines in oil prices. And we just have here a simple chart of WTI futures and Brent futures and how they've been generally moving to the downside over the last, 2 weeks, 3 weeks or so. And I just was interested to look at this because we haven't actually seen any releases from strategic petroleum reserves yet, but it is the conversation around that seems to be so powerful and putting some downward pressure on prices. Seema Shah, Chief Strategist at Principal Global Investors, joins us. And I wonder, Seema, how much you're thinking about a top in oil prices for the moment around these themes and whether that is playing into some of your thinking. Have we seen the worst, seen the highs for oil prices?
Hi, Anna. Well, look, I mean, when we've been thinking about oil prices, if you take the supply out for the time being, what we've been anticipating is you have that winter surge, and then, of course, that's putting up demand, and that's putting up oil prices. And then once you get into 2022 and you start to see a bit of a global growth slowdown, that's when you start to see prices move. Now, with the change in supply conditions, of course, that can create that additional volatility and hopefully put a bit of downward pressure on oil prices from here.
So, but only for the short term, right? And the question is, what does the kind of inflation that we've seen, and I'm sure most people expect to see it continue into next year, what does that mean for the Fed and for other central banks?
Yeah, that is the key question because, as we've been seeing with the inflation numbers moving up, and one of the reasons, of course, has been that energy price situation. Now, of course, we know that most of the central banks do look past some of those oil price rises. But we have to be considerate about demand destruction. What does that actually do? Is it really a tax on consumer spending, which, essentially I think for Europe it really is a bigger issue. But we are anticipating that central banks try to look through any of the oil price moves until it starts to hit inflation expectations. So actually, I don't think the dialogue changes too much from that perspective.
Does it change your... I mean, what do you think of the TINA proposition that Anna was talking about earlier? Is there any alternative to stocks in this market?
No, look, we believe that US equities, European equities is really your favorite place to be. Generally, risk assets should do well. And I think that we've been thinking about bond yields, we've been seeing them move up, but ultimately, as long as real yields are very depressed, and you still have strong growth, which we've seen from the latest very strong earnings season, actually the dialogue for equities is actually still quite strong.
We've been talking about pricing power, Seema, and we talked to Hassam Asset Management earlier, Yogi Dewan. He was saying, look, I'm going to avoid companies like Walmart and Target, companies that absorb those costs and don't pass them on to consumers. Is that a strategy worth pursuing?
Oh, absolutely. As we move into 2022, we've got to be very cognizant of all the supply chain issues. And I think what was interesting about Q3 was, as well as seeing really strong demand, you were hearing that a number of companies were worried about their margins. So from here on, it's really about picking those companies, which ones have got the deep pockets, the pricing power, and ability to absorb, but also hopefully to push it onto the consumers. So that, I think, will be a key decision going forward.
What do you do with technology in this environment?
We still do like technology, and I know that's a little bit surprising to many people as they see bond yields rise. But ultimately, when the economic environment is becoming a little bit more challenging, and we are thinking about people that have pricing power, companies that have pricing power, to us it looks like mega cap technology, and also considering it as a structural trend going forward, we still think it's a good place to have some exposure within your portfolio.
So you like US equities. We keep hearing a lot of people talk about the attractions of European stocks. Maybe they're slightly less expensive compared to their US peers. But are you concerned around COVID? Is that going to be something of a theme through the winter, and do lower vaccination rates in certain parts of Europe start to become something that the markets move around?
I think it's something that we need to be considerate of. But to be honest, when we look at a lot of the European countries, and actually globally, aside from Asia at the moment, we are starting to look past COVID. We do feel like a lot of governments, although they're talking about lockdowns, we think they'll be very, very targeted. So we don't see too much of a downward pressure on growth from COVID going forward, unless, of course, we get some major shock from a variant. So to us, COVID is something we're hoping it's going to be a 2021 story, and it doesn't continue with us into 2022.
I was talking to one of our colleagues on the Markets Live blog earlier on, and he was saying his story for 2022 is all around food price inflation. We've seen quite a bit of that already. Is that something you would expect to really be to the fore in 2022?
It certainly could be. I mean, if we think about 2021, what is the focus for 2022? It's inflation overall. So I think from our perspective, a lot of it is going to be shelter inflation. That is the underlying price pressures that are suggesting it's broader, more persistent. So we have to keep an eye on that. And of course, food price inflation is particularly important for emerging markets, and there is so much focus on that.
And in those emerging markets, it's only a short jump, of course, from food price inflation to political movements. Seema, thank you very much for joining us. Seema Shah of Principal Global Investors. Coming up on this programme, Bill Gates predicts COVID deaths could fall below seasonal flu levels next year. We'll get the latest conversations around COVID. More from the billionaire co-founder of Microsoft speaking to us in Singapore. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, the Coty CEO, Sue Nabi. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie alongside Anna Edwards in London and Matt Miller in New York. It is the second day of the New Economy Forum, and COVID-19 remains a topic of concern as flare-ups around the world continue to impact lives and hamper economies. Bill Gates, founder of Microsoft and co-chair of the Bill and Melinda Gates Foundation, told Bloomberg COVID may get to flu levels by mid-2022.
Well, the vaccines are very good news, and the supply constraints will be largely solved as we get out into the middle of next year. And so we'll be limited by the logistics and the demand. In a lot of countries, it's not clear what the demand level will be ironically, in a country like many in sub-Saharan Africa, where the epidemic hasn't been as visible, your demand for the vaccine, it's challenging to generate that, but we'll do the best we can on that. The other thing that's pretty impressive is that, you know, Merck and now Pfizer have oral antivirals that the Merck drug, we've been able to reformulate to get it to be less than $8. And so we'll be able to have anyone whose age or medical condition makes them have significant risk immediately begin what's called presumptive treatment as soon as they test positive. So between natural immunity, vaccine immunity, and these oral treatments that can scale up in a way that the antibodies never did, you know, the death rate and the severe disease rates ought to be coming down pretty dramatically. And, you know, by next summer, getting to be, say, quite a bit lower than the average seasonal flu level is, assuming there's no surprise variants, which right now the evidence is that's not that likely, but it can never be ruled out.
What do you think, you just mentioned next summer, what do you think victory looks like in this? Is it effectively taking COVID back? You also mentioned the flu. Is it effectively making COVID a kind of flu-like disease? I know it is, but is that the kind of version of what victory is in your brain?
Yeah, things are fairly binary. I mean, if, you know, death rates from driving were 10 times what they are, people might think, wow, shall we do it or not? You know, flu is accepted. The, you know, average years of life lost for both flu and COVID is about 8 years because it's so prevalent in the elder versus the young. And we accept about a 60,000 average per year rate there. Now, I happen to think as part of the tools innovation to avoid the next pandemic, we ought to go and eradicate flu as well, because its mutations are another source of a significant source of future pandemic risk. But yes, the idea that economic activity will resume in full once you get to flu levels, it's very likely. Now, you'll have some hot spots where you'll still have to have non-pharmaceutical interventions or, you know, huge incentives for people to get protected.
Bill Gates speaking there to our editor-in-chief, John Micklethwaite, at the Bloomberg New Economy Forum. And Matt, really interesting to think about the role that the pills are going to play here, that the oral treatments could play here. I spoke to a professor in this field just earlier on this morning, and she was saying just to be a little careful with some of the positive test results there. A lot of that's happening in the unvaccinated, and so does it really add to the arsenal for those who've already been vaccinated? But clearly, a lot could change next year.
Well, and I mean, you also have to catch the disease, get tested, realize that you're positive, and start the treatment fairly quickly within a week. You know, Bill Gates was talking about some sub-Saharan African countries where the pandemic hasn't gotten quite the publicity. In those countries, it's probably less likely that when you get flu-like symptoms, you're going to immediately test and get an oral treatment. But I do think it's interesting that he said we should consider eradicating the flu, trying to eradicate the flu, because that will be the source, is a likely source, a potential source of future pandemics. You know, we wouldn't even have thought that possible 2 years ago, to eradicate the flu. That was just a part of daily life that we accepted and killed so many tens of thousands of people every year. But now we're at in a place where we could.
It's really interesting, Tom, isn't it, when you think about the way that China is using still a zero-tolerance policy when it comes to COVID. You wonder how long that policy can last if we are going to enter into a phase, and we have in a lot of developed markets where other parts of the world are just kind of living with COVID.
The other issue for China is that they've been using Sinopharm and Sinovac, where we know the efficacy is much, much lower than Pfizer, Moderna, and even AstraZeneca as well. So when they get to open up the borders, what about the impact on a population that is largely unaffected by this pandemic? So that is a key question for the authorities in China.
Yeah, absolutely. Be sure to stay tuned to Bloomberg for the rest of this week. We'll be bringing you conversations conversations from the Bloomberg New Economy Forum in Singapore. This is Bloomberg.
I think inflation is getting to be a lot more structured for 2 or 3. Happens is when you start seeing sticker prices of 6 and 7%, that starts building inflationary expectations. And once inflationary expectations get anchored, then you get into the spiral. So I don't think it's such a temporary phenomenon.
I am concerned about inflation because I think at the same time as the supply chain recovering, there are some new issues. Supply chains are repositioning, partly because of geopolitics, partly because of resilience considerations by governments. Oil prices are going to remain high for quite a while.
When I step back and I think about my 40-year career, there have been periods of time when greed has far outpaced fear. We were in one of those periods of time. Given that it feels like inflation's running above trend, chances are interest rates will move up. And if interest rates move up, that in and of itself will take some of the exuberance out of certain markets.
Few highlights there from the Bloomberg New Economy Forum in Singapore. Let's get over to Tom Keene right now, co-anchor of Bloomberg Surveillance. And Tom, you know, we've heard some, on the one hand, pretty optimistic outlook on the evolution of the pandemic from Bill Gates. On the other hand, we're seeing numbers that are just eye-popping in the heart of Europe with, 1,000 new cases in Austria per 100,000 people. I'm almost afraid to go back.
Well, it's really changed. I mean, I noticed today some success, and I believe it was Lithuania and Estonia, Matt, but all in all, we're really focused on this. I think John Farrow has a really unique perspective because he has lived this moving around folks within quarantine, as does many of our team in Asia. But Matt, you're right. It doesn't go away. That's clearly what we're hearing from the medical crew at Johns Hopkins.
And Tom, I know that we've got Turkey in our sights today. We've got an interest rate decision in Turkey, and that's something that's on your mind this morning.
Well, it's an interest rate decision, but what it is here in the backdrop there is what we just heard from Singapore on inflation. This is really percolating, and the inflation chart is simple. It goes the opposite of devaluation to a much higher inflation. This is from an emerging market, Istanbul 5% level. And up we go, nearing 20%. The FT headlines today just beneath 20%. I think our statistic is 17%. The answer is it's a lot.
Yeah, I had to wonder whether investors need to carve out Turkey out of the EM basket or whether there is a read across to the broader space.
Yeah, this is a really, really important question. And I've always carved it out, Tom. I've been there a number of times. It's a two-tier fixed income economy, 2 parts, lira-based, dollar-based, et cetera. And you're right. There's always a discussion to carve it out of EM, and that now that'll be completely revisited.
Okay, Tom Keene, co-anchor of Bloomberg Surveillance, on the importance of that expected rate hike that we're looking at, rate cut, I should say, out of Turkey. That's one we're looking at coming up. Thank you very much indeed. Now, look at what else we are watching. I'm watching Alibaba. It is their quarterly results. We're going to be watching, of course, for things like the retail impact. We know the consumer in China is not back up to where it was pre-pandemic. But of course, it's all about regulations as well. So whatever the executives have to say on the regulatory front, I've been messaging the team at Alibaba. They tell me the earnings should be out in about 7 to 8 minutes' time. So I'll be watching that and the read across to the broader tech sector in China. Matt.
Oh, it's good to have an inside guy, Tom. I am watching, well, listen, tomorrow's going to be my last day here in New York for a few weeks. I go back to Berlin. I need to get all my stuff and bring it back. So there's 2 issues there. Number one, I'm making it Flannel Friday. I'm having everyone wear a flannel shirt tomorrow.
We got the memo. Not on air, though, I should point out.
Not on
I think
air,
I'd get in trouble for that.
But we've got a lot of people here working behind the scenes that, are making the sausage, and they're going to be making the sausage in flannels tomorrow, I hope. Number 2, I'm hoping to come back. I'm excited to come back, but I'm worried about the COVID situation in Europe. I'm going into basically the eye of the storm here. I remember at the end of this summer when I was in Spain with my lovely wife, and we were so concerned about our friends in New York because the case rate had jumped up to 300, 320, 340 per 100,000 in New York. Now we're looking at that in Germany, 392. So even more than that in Germany. 993 in Austria, or just about 1,000 in Austria. The situation in Europe has gotten a little bit out of control, and I'm concerned to head back into the eye of the storm, especially with my family.
Right, yeah. Well, Germany now with record cases, but on the upside, if you're looking for the comforting messages, I saw that the German Vaccine Authority is now recommending boosters to everybody over the age of 18. So if you haven't had that yet, you can get in line for that one. Matt, I'm watching what's going on with interest rate decisions from Turkey. We've talked about this with Tom Keene, and despite the high inflation rate, there is an expectation that we will see a cut in interest rates, a third consecutive 150 basis points cut today. So we'll see if that comes through. But interesting on that note to think about the divergence between Turkey and other emerging markets. To Tom's point earlier on, to Tom Mackenzie's point, we just saw Hungary raise its 1-week deposit rate. And if you add up all that Hungary has done this week, they've delivered a big weekly rate hike in back-to-back steps, that putting upward pressure on their currency. So the divergence across emerging markets, certainly something that we are watching very, very closely. Now, more Bloomberg surveillance is ahead. We'll be hearing from Steve Viting, who is from Citi, and Megan Green of the Harvard Kennedy School. All of those conversations coming up, plus plenty more from the Bloomberg New Economy Forum live in Singapore today and into tomorrow. This is Bloomberg.